we've received, since the beginning of the year, quite a lot of redemption requests, more than usual, I think. And I think that people are really unhappy and skittish about where the world is going. And they are unhappy, people are unhappy about the huge overhangs of debt that have arisen because of COVID. And governments did absolutely the right thing by unleashing vast amounts of cash into the economy. And they took on an enormous amount of debt. And so people are looking at the debt overhang. And then we got, Russia decides to invade Ukraine, and who knows, they might invade Poland next, and just imagine what happens then. And so people get really skittish, and they want to pull their money out. And the point that I want to make to them, but I can't, so I'll have to make it to you. I can't make it to them because when somebody wants to take their money out, you don't ask questions, you send them their money, it's their money, So it would be really, really bad form for me to then get on the phone to them and say, look, I really think you shouldn't do this. They're like, what are you talking about? I want to do it, leave me alone. So, but I actually think that given the extraordinary difficulties that it looks like we're about to go through, the very, very best place to be is businesses. I would say equities, but if there's at least one person here with a family business, but in businesses, and I feel I can explain why, and perhaps also real estate. But here are the places you absolutely don't want to be. You don't want to be in cash. You don't want to be in crypto. Sorry, all you crypto fans. And you don't want to be in commodities, gold and silver. And I hope that I can explain why. And I'm going to do that for 5 or 6 minutes. And then I am going to talk about the evolution of the Swiss financial sector. So the problem with cash is that, as we saw, inflation in the United States last year was 7.5%. It's depreciating by 7.5% per year currently. The cash you hold in your bank account. And so I guess I'm talking for an American perspective. We live in Switzerland, at least I live in Switzerland. But the world I'm investing in is a global world, and my investors and I would not feel comfortable purely investing in Switzerland. And I guess we could go into why not, because you could actually do that. So in Switzerland, cash is not depreciating by 7.5% per year, but the US dollar, which is still not Bitcoin, the currency by which we price just about everything, is depreciating by that amount. So unless if you're an investor and you have like an expenditure that you think will come up within the next year or two, if the expenditure comes up at the end of 24 months, you will have already lost 15% of your purchasing power. So I don't see much point in holding cash. The problem with crypto for me is, even if you trust it in all sorts of other ways, is not a very reliable store of value at all. I'm not sure that I'd want to have 100% of my reserves sitting in something that is bouncing around like that. I think I almost would prefer cash depreciating at 7.5% per year, because at least I know the rate at which it's depreciating. It's predictable for me. I can plan around that, whereas crypto I would not be able to plan around. In fact, if you put a gun to my head and said crypto, I'd rather just be in gold and silver. But the thing about gold and silver and crypto, for me, is that they're not productive assets. And I think that, and forgive me, because I'm going back to kind of something that I've said a lot, the reason why wealth is created is because businesses deliver things that people want on a consistent basis. And you don't want to be like the giants in the Rheingold who just take their gold and they look at it and fight over it. You want to deliver value to society. And when you deliver value to society in a consistent way, then society will reward you. And so I think that those are the places where one wants to invest. I can go into real estate a little bit. So real estate does not deliver as much value to society as all of the companies that are out there are, but it's an extraordinarily durable asset, and you can own it 100%. and it will survive wars and meteorites, hopefully, and all sorts of calamities, and that's what we're looking for. So I think that real estate is fine, but it's really businesses that create things that people want, and when they create things that people want, they grow. And that's the place where, if you look at the Forbes 500 list, if you look at the richest people, Bilanz in Switzerland, all the people there, or the vast majority of people there, are people who were long-term owners of businesses that delivered something that people want into society. So that maybe took less than the time that I thought it would take. I guess, just briefly rewinding, do I talk about inflation? Or do I move on to the financial center of Switzerland? I haven't moved my slides on, so we'll see where we were here. I think I did, I think I did that. Oh, this is a big topic. I should get into this. Should I? The time went. We've got 15 minutes. We've got to stop at 7.
We can add a little bit of time. We need to leave the latest 7.
7 what? Chantal, I will take my guidance from the officers of the investment club. Where are the officers? Yes, tell me. Okay, I will, where am I here? So, I don't know, this may be obvious to you. I'll just stay with inflation for a second. So a big revelation to me, and I am going to give a nod to your professors. So I read some guys called Reinhard and Rogoff, who are at the National Bureau of Economic Research. They, in the United States, they are a husband and wife team, and they made it their business to study debt and debt defaults around the world, and they're enormous experts in it. And I discovered a term that is really, really valuable to me. It's called financial repression. And so when we think about the debt overhang, there are many ways that we might get out of the debt overhangs that exist in the developed world, in the West, without having inflation. For inflation, I believe, in spite of the 7.5% in the United States last year that the FT reported, it might still be a temporary phenomenon. It might be all related to supply chain. It might not be runaway inflation like we had in the 70s or like you might have in a hyperinflationary country. And so you might ask, how do we get rid of the debt overhang? And there are multiple ways we could do it without inflation and without defaulting. And one of them might be to just grow. If we manage to maintain interest rates of 1 or 2%, and for some reason we manage growth rates of something above that, then the amount of debt, you would have something called R minus G minus R. If any of you are mathematicians in the room? Yeah, maybe? No? Got a blank stares, but we can look at it afterwards if you like. If the economy is growing faster than the rate of interest on the debt's going to become a smaller and smaller proportion of it. The country could privatize assets if there are assets to privatize. And the United States, if it wanted to, could privatize a lot more. I mean, the United States federal government owns enormous amounts of land, and that land is becoming more valuable as more and more people live on it. The United Kingdom, there's something called the Crown Estate that owns all of the shoreline of the United Kingdom and all of the mineral rights that exist around on that shoreline, and all of the fishing rights for that matter. That is, I don't know what it's worth, but it's an enormous amount. And so there is privatization, but financial repression is simply the various mechanisms by which the Federal Reserve or the central bank forces banks to accept, and savers effectively to accept, less than the rate of interest than they ought to accept if it was a market rate. And the example that I have from studying at around your age, Japanese political economy, is the Japanese postal saving system, where vast numbers of Japanese housewives, I believe to this day, will only deposit their money in a post office bank, and they get next to zero interest rate. And that is, they're not getting what they should get on their money, but that enables the government to borrow at below market rates. And I think that one of my investments, actually, somebody's going to do an internship of Bank of America, go get them because we have an investment in Bank of America. And something that you might enjoy going and doing if you're interested in this kind of thing is to go to the Federal Reserve website and just look at how many regulations the banks have to comply with, which are being promulgated the whole time in the most minute way. And we were recently regulated, well, 5 years ago, regulated by FINMA. I promise you, it's got no, you cannot compare. And what people don't realize is that these guys are kind of like franchisees of the central bank. The central bank has got the good stuff. It can give them free money if it decides to, and so you cannot get into trouble with the central bank, and they comply with the rules, and if that includes being forced to get a lower interest rate on your debt than you ought to, then you will do that as well. So I think that there's a misunderstanding in my investor base on the impact of inflation and higher interest rates on a portfolio. Look up any hyperinflationary country and look at the stock market, and you see the chart for the value of the stock market goes straight up. And so this idea that just because you've got inflation, stock values are going to come down is not necessarily true. I think that it's very likely that the absolute nominal level of prices will go up. So we could have inflation and we could have higher interest rates, and the stock market could be higher as well because it's reflecting the higher asset prices. It doesn't mean that your purchasing power is any greater. What's my point? My point is that even inflationary times, productive businesses are the place you want to be. There's my talk on inflation. So I'm going to try and bring this in by 7. This might be the most interesting for at least some of you here. I don't know. But this is a whole topic, and I see, like, are we doing okay here? Is this interesting? Are you falling asleep, or am I helping you in any way? Do you think, will I get good grades for the talk? I don't have any notes here for this, but I can look at the chart. Maybe I do. Let's see. I should have notes somewhere. Then I don't have to look up at the. Did I make notes on that? I did, but they're not here. That's okay. I'll look up at this. Oh, there we go. Check that out. So I know that there are some people here who are Buffett aficionados. Some people aren't. And I'm sorry if you're not. You're going to just have to catch up. But Ben Graham came out of the Great Depression. After the Great Depression in the United States, nobody wanted to buy equities. People were completely demoralized. And as a result, there were large numbers of companies out there that had the market capitalization of the company was sometimes less than the cash on the balance sheet with no liabilities. Sometimes it was less than the liquidating value of the company. It's like, I dream of being able to do that kind of analysis because it's so easy. You have, what people used to talk about was holding a Geiger counter over the balance sheet. Warren Buffett comes along and he's like, these things are not so interesting. I'm going to focus on earnings power. And actually, I'm even going to pay up for earnings power because I can find these companies like Gillette or Coca-Cola that I know it looks like I'm paying a high price today, but actually, if you look at where these earnings will be in a decade, it's going to be awesome. They're going to have gone up 10 times, and you'll see that the price, and that's true for Coca-Cola. Berkshire Hathaway gets paid more in dividends on their Coca-Cola shares than they paid for the shares originally, which is kind of like an astounding number. Then in my little potted history here, we have this guy, John Malone. And I've never invested with John Malone, but anybody who's interested in investing should go read a book called Cable Cowboys, is one of them, and the Something Shell game, which kind of shares the extraordinary way in which he built up this empire that was TCI Communications. He built up the cable industry in the United States. And he didn't focus on earnings. He focused on the ability of these companies to produce cash. And the fact of the matter is he bankrupted quite a few of these companies along the way. But he found ways to take control of them outside of the bank, on the other side of the bankruptcy court. Very, very smart guy. But in a certain way, he was applying the same kind of metrics and techniques that Warren Buffett was, but he was looking at the company in a more nuanced way. I just want to bring you up to the present day. where in my portfolio, I do own some Twitter, and I do own some Google. But I am surrounded by friends, so you guys will be interested in this because I'm going to name some companies that you maybe have some familiarity with. I have a friend who owns a chunk of Spotify, and we all have Spotify on our phones. And I have a friend who took me through his analysis of Salesforce. We use Salesforce in my office, and it's a phenomenal product. And then, of course, we have the famous case of Snowflake that was invested in by some guys at Berkshire Hathaway, and that trades at 100 times revenues. And anybody who wants to, if you assume that 100% of the revenues are paid out as profits to the shareholders, by how much do revenues, and they're obviously not going to do that, they're going to have some expenses, but by how much do revenues have to grow and for how long for you to start looking like you paid a low price for the company? And in order to come to the conclusion that these companies are actually cheap, the analysts, many of them are friends of mine, engage in a kind of analysis that I am really struggling with. And in this letter that I wrote to my investors, there's one part of the letter where I completely disparage these valuation metrics. And then on the other side say, yeah, but I still have to engage with them because there's something real going on there. And so this is where I can part company with your professors, because I don't actually have to, and I don't have to, so you see somebody who's genuinely engaged with this stuff, but is genuinely confused and hasn't figured it out for himself yet. I am very certain that to pay 100 times revenues is not a smart idea, but I have people who I respect very highly who tell me that it's just because I don't understand it, and I ought to be willing to pay that. And the fact of the matter is, if I were just taking products that I use happily in the office, like Salesforce, or privately, like Spotify, and I just invested in those, even though they make no money, I would have done extraordinarily well in spite of the declines that have happened recently. And I have an understanding of what's going on. And I think that my job in trying to grapple with those kinds of businesses and get margin of safety is extraordinarily difficult, and I haven't figured out. So what I've done is I kind of just stayed away. But so I guess it was only 2 or 3 years ago where I understood this idea that, and it's just a powerful idea that I'll share with you, and then I'll leave the others out because I only got 5 minutes to go. It's sort of like network dominance. So you have these companies that go after market share because once they dominate the network, it's an extraordinarily high barrier to entry, and then they can make large amounts of money. And if you think about WhatsApp, the network effect of WhatsApp is absolutely insane. And well, I'm curious. We can start with me asking you a question. So, well, we don't have numbers, and I don't have the numbers in my head, but Warren Buffett asked the question of the Wall Street Journal. He said, if you gave Warren Buffett $1 billion, I think was the number, he would not be able to displace the Wall Street Journal as the leading business newspaper of the United States. And so, we have Telegram and Signal, and how much money would you need in order to displace WhatsApp from people's phones? I don't know. It could be infinite, could be impossible. And to that point, quick story that I heard on a podcast. Jeff Bezos approaches James Courier. Jeff Bezos apparently was on the board of eBay, and James Courier, who's a venture capitalist, was invested in eBay. And Jeff Bezos says, we're going to compete with eBay in auctions, and maybe you want to step off the board because it's not going to be pretty. And 5 years later, with Amazon, with all its resources, throwing everything they could at the idea of auctions, and in spite of eBay being a really, really clunky business, and a clunky website, and not the great software programmers, and all of those things, Amazon could not dent their business. And so you get this, and that's true probably for cloud computing like Amazon Cloud and the other cloud companies, where the lock-in effect is absolutely insanely enormous. And then my problem is that we all want to invest in the next Amazon, eBay, WhatsApp, but there are all these companies masquerading as the future Amazon, eBay, WhatsApp, like WeWork, like probably Uber, like probably a bunch of other companies. And I decided 6 months ago that I needed to really study very carefully the venture capital firms and what they're doing. Me, a value investor, a guy who worships at the church of Warren Buffett, because I could see what extraordinary things are coming out of there. And it's really hard because the sales machine that is Wall Street has been well written about, but there's an extraordinary sales machine in coming out of Silicon Valley, which is kind of pumping up these companies, giving people reasons to buy their shares, to keep the valuations high, because there's a whole kind of food chain that has to take place. And I, as a public investor, stand at the end of it. What's my point to you? It's really hard, really, really hard, and I don't know what the answers are. And maybe one of you will give them to me, and maybe sooner or later I'll discover the answers. What I would tell you, so last point on that is, and then I'm going to talk about Switzerland very briefly, is that I think that a lot of business narrative and stories about success in business are written in a way that the writer has to entertain you. And so they're going to come up with like the 3 big things that the person did, and like as if that's what's going to get you to nirvana and success. And the reality is that it's not 3 big things. It's just trying to push yourself a little bit further on a daily basis, trying to get a little bit further and sort of like strengthening those muscles. And if you keep trying to do it over a period of 1, 5, 10, 15, 20 years, eventually you discover that you've gotten somewhere. So what do? I grapple with the stuff that I've just shared with you. In a certain way, I'm grappling with it here. And if I just keep trying, eventually I'm going to find that I'm in a different place when compared to the person who didn't keep trying. So